Hello and welcome everybody. I'm Stephen and I'm a popular investor on eToro. Thank you very much for listening to this video today. And as usual, please don't forget to like this video and subscribe to my channel. That will be really helpful. I appreciate every single one of you. Welcome to all the new copiers that have come on board recently, and thank you again to my loyal copiers that have been with me for a long time. It's really happy to have you around. We're doing a lot better at the moment. We're having a very good 2023 so far, after obviously what was a difficult 2022, but I'm very happy with our progress that we're making. And in today's video, I'm going to be talking about some of the things that happened in the market last week. And I'm also going to be explaining a little bit more about our portfolio, what we're bullish on, and our hopes for the rest of 2023. So without further ado, let me get started. And I'm sorry I haven't been able to make a video over the last couple of weeks. I've been a little bit busy, but I thought I would make up for it with a nice comprehensive video for you all today. So as I said, our portfolio did really well last week, and it was up about 4.27% overall for the week, which is a very good result. We outpaced that of the Nasdaq, which was up about 3.3%. and the S&P 500, which was up about 2.4%, and Bitcoin, which was up just a little bit at about 0.54%. So why did we perform very well last week? Well, the S&P and the Nasdaq both had a very strong week. Europe showed some strength last week. Some of our European stocks did pretty well, and China continued to rebound. We had some nice rebounding in China, which we have a relatively large portfolio holding in. As I said, Bitcoin was only up slightly, but some of the altcoins in our portfolio were up heavily. So I'll explain a little bit more detail about this in our crypto section. But last week, the case for Ripple versus the SEC was finalized, and it came in with a partial win for Ripple. Really, what the biggest taking from that judgment is that XRP, it won't be considered as a security in the future, and people will be able to buy this on exchanges. This was very good, not only for XRP, but also for Stellar Lumens, which is a very similar type of project, and it was a fork of XRP. And that's in our portfolio, and that did really well last week. It was up something like 35% or something around that. So that did very well in our portfolio last week. We also saw, because of the Ripple case winning, and because XRP was deemed not a security, this was also good for a lot of the other altcoins, which were in the case against the SEC case against Binance, in which they outlined some of the securities which they said that Binance had been selling on their exchanges without approval. And some of those were Solana and a few others, which I won't go into detail now. But and also Cardano, which was another big one. Both are in our portfolio. So Solana and Cardano also outperformed last week, because this weakens the case for the SEC versus Binance, because if they can't be classified as securities, then they haven't done much wrongdoing. We also saw a big adjustment in the price of Coinbase as well, which is another portfolio holding, another reason for our outperformance last week. I also have started to do some short-term positions again. I did take a little bit of a break from this for a few weeks, and that was because, as I mentioned, I think in my last video a few weeks ago, we were in a little bit of an uncomfortable zone in terms of kind of short-term trades. Stocks, for example, weren't at highs, but they weren't at lows anymore. They were kind of that kind of mid to higher level range in history. A lot of the commodities weren't showing much value for me, either on the short side, the sell side, or the long side. So I hadn't really done many positions in the last couple of weeks, just because I didn't feel that there was the comfort zone and the margin for safety involved in doing that. But last week I did some short-term positions again. I did a short-term sell position in oats, which is a commodity, and I closed that at about 17.4% profit. And also Euro natural gas, which is a bit different from natural gas, which is in the US. This is European natural gas. It's a little bit more volatile, but I took a buy position there as it was at a very low price and it had swung down significantly, and I managed to make a profit of 12.36%. So a very good profit nonetheless. I also did a short position in Bitcoin Cash, and that is because this had gone up significantly over the last kind of month or so. That's because it was listed on a new exchange, which is backed by some of the large asset managers. But I felt like a kind of 130, 140% increase over a month was overdone. So I took a short-term position in this, and I have since closed this out at a small profit of about 3 or 4%. I also think Bitcoin Cash is a weak product, a weak crypto. I don't think it's not the real Bitcoin. It hasn't had a lot of success since the hard fork. Not many people are using it, and I think it's a little bit of a dead project, to be honest with you, and a failed experiment. So if we look on a 2023 year-to-date benchmark status, our portfolio has done extremely well, as I mentioned, and we're up about 21.51%. And that is comparatively pretty good, I think, for what it composes in our portfolio. So it's very hard for me to actually have a specific benchmark, because we have a real mix of different asset classes, different geographies, and a whole host of different things. So if we look at some of the benchmarks in which some of our portfolio is made up of, the S&P 500 is up about 17.3%. So we are beating that benchmark. We're down a little bit if we compare that to the Nasdaq, which is obviously 2022 tech stocks did extremely poorly, and the Nasdaq, because it's made up of a lot of tech stocks, has done very well with about 34.80%. But a lot of that is to do with some of the largest weightings in the Nasdaq, which have made up the vast majority of those gains. It hasn't been spread out between all of the different Nasdaq components. If we look at the FTSE 100, the UK hasn't done that well this year. I did say earlier in the year that I didn't expect the UK and Europe to do that well this year, and that is because they're significantly behind the curve on fighting inflation compared with the US, and they're only up about 3.85%, and they're still increasing their interest rates, and I think they still have a little way to come before they can make a real impact on inflation. Hang Seng Index hasn't done very well. To China hasn't done very well if we compare that to some of the expectations that we had at the beginning of the year, because of many reasons, really. And one is the expectations that the reopening would have been a lot smoother. There'd have been a lot of demand for products and services, and this would have really driven the economy. However, it's been a bit slower than expected, and I think that's because a lot of people hadn't completely returned to work. Productivity was still pretty low. They were still kind of recruiting people. There was the ailing property management, property real estate sector that was obviously in a bit of a crisis as well. And all of these things take a little bit while to recover after COVID-19. expecting a better end to 2023 for my Hong Kong related stocks. And I think going into 2024, I think it'll be a strong recovery year. Bitcoin is up a whopping 82.73%. Had an extremely great year. I'll go into a little bit of detail about that. But a lot of that is about the anticipation of the halving in around April 2024. A lot of Bitcoin is leaving exchanges, which could lead to a supply crunch in the future. And also we have seen ETF, spot ETF filings from some real industry Goliaths such as BlackRock, Fidelity, Invesco, and many, many others, which are due for approval either towards the end of 2023, or if it goes to the final SEC final deadline dates that they can be kind of pushed back to, then it could be early, just before the halving in 2024. Anyway, I'm anticipating that there could be a lot of upward pressure in terms of the Bitcoin halving cycle in 2024 and 2025. As we move on to the main news last week, as I mentioned, the Nasdaq and the S&P had another strong week. After a strong recovery this year, we see the S&P sitting very close to all-time highs. I think it's about 6.5% away from all-time highs now, so it's not very far off. So a significant rebound of what we saw last year. Last week, we also saw a lot of different data that was released. So we saw the Consumer Price Index, which is also known as CPI, which is a inflation data metric. We saw both headline and core inflation rose 0.2% in June, which was below expectations. The annual increase in headline inflation has slowed to 3%, its slowest pace since March 2021. Whilst core inflation slowed to 4.8%, the slowest since October 2021. If we compare that to what the CPI data was at the peak, I think was in June 2022, we've seen a significant decrease to 3%. Don't forget the Fed target is 2%. So we are seeing significant inroads to reducing that inflation, and we're not a million miles away now from the Fed data. It's quite likely that they are going to keep increasing the interest rates for a short time and then keep them in place for a while. And they will probably do this for longer than they should do, because a lot of this inflation data is lagging. And a lot of it we will only see the effects of holding it for a longer time in the future. And at some point it could go below the 2% Fed target rate, and then we could see a very quick an emergency slashing of interest rates, because governments really don't like deflation. We also saw data from the Producer Price Index, the PPI, inflation data. That was encouraging. Headline producer prices rose only 0.1% over the year ended in June. Core producer prices rose 2.5% over the period, and that is the slowest pace since January 2021. We usually see the producer price inflation data front running the CPI data, because a lot of stuff is obviously produced, and only many months later does that actually go into the CPI inflation data, if it's increased or decreased in the cost of producing something. So again, all encouraging signs to see that we could have a soft landing in the economy, and we could be nearing the end of this inflation rate rising period and quantitative tightening. We've also seen weekly jobless claims actually hold up extremely well, and they have done throughout this whole period of actually increasing interest rates. The number of weekly jobless claims fell back more than expected to 237,000 jobs, reversing all of the previous week's jump. So kind of on a short-term basis, we're seeing those jobless claims come down, but also on a long-term basis, we're still seeing jobless claims fairly low historically if we compare that to the federal funds rate, which is the interest rate. However, as I mentioned, the European Central Bank in Europe and Eurozone in generally is a lot behind the US in fighting inflation. Inflation's a lot higher still in Europe, different around different countries in Europe, but it's still very high. And what the Eurozone is saying is that it was seen as essential to communicate the monetary policy had still more ground to cover to bring inflation back to target in a timely manner. Obviously, that means that they don't feel that they have done enough yet to suppress inflation. And they added to that interest rate, they plan to increase interest rates possibly beyond July. And this could be considered if necessary. So if those inflation data doesn't come down significantly, they could continue to increase those interest rates all the way through to at least the end of 2023, in my opinion. The UK economy hasn't been that strong either. And the UK economy has shrank 0.1% sequentially in May after expanding the previous month for 0.2% in April. However, the UK indexes did actually pretty well last week, and a lot of that is because economists and analysts had said that they expected the contraction to be around 0.4% instead of the 0.2%. So it actually beat those estimations, which were probably priced into the cost of equities. We also saw the Royal Institution of Chartered Surveyors have said in its June report that Britain's home buyers have pulled back from the property market at the sharpest pace in 8 months. So this is not surprising at all, because obviously the interest rates have continued to increase. That means that anybody who is buying a property, especially first-time buyers and other people, if they're buying a property, they have to, at least in the short term, fix into a very high interest rate price. And a lot of people cannot afford these mortgage repayments. There's also a cost of living crisis still in the UK, and many people just simply couldn't afford to lock in new mortgages, which most of the time are over double to triple what the original payments had been on another house if they were existing homeowners. So we've seen the measure of new buyer interest has tumbled minus 45% from minus 20% in May. So that's accelerated. The average rate on a 2-year fixed mortgage loan has risen to 6.6%, the highest level since August 2008. So as you see, that interest rate rise and those payments are either unaffordable or unattractive for a lot of new buyers, which has brought down the demand for buying new houses. Over to China. China did pretty well last week, and that was for a number of reasons. Last year, China rolled out the 16-point stimulus plan. So China is really doing quantitative easing when a lot of the world is doing quantitative tightening. They rolled out this plan last November. And what they've decided to do is they really want to provide an extension to that existing 16-point stimulus plan to include more support for the property sector, which obviously had its difficulties last year. And they aim to defer property development loans and encourage financial institutions to ensure the delivery of projects. So that's basically to stop developers stopping the project because they've run out of money. So they're providing loans to them, as well as providing property developed loans for potential speculators and buyers who want to build new properties, kind of stimulate that economy. So I guess it's a positive sign. It's a negative sign in the fact that obviously the demand for housing is not significantly high. New housing is not significantly high, but this is really helped by the Chinese policy to encourage some stimulus in these areas, which could be good in the long term. We've also seen Chinese financial regulators have imposed a fine of more than $1 billion on technology giants such as Ant Group and Tencent Holdings. This penalty has widely been seen as an end to the 2-year probes into Chinese biggest internet companies. So what I mean here is that there was a lot of clampdown during COVID on some of the large tech companies. So as I said, Tencent, Alibaba, JD.com, many of those different large companies where the government was very worried that they were getting kind of monopolistic practices or anti-competition type of practices. And what they really wanted to is they wanted to go to this ambition of common prosperity around the people, to distribute the money and liquidity around the population. And they really kind of clamped down and put a lot of policies in place which really hamstrung some of these very large Chinese tech companies. And those have been kind of rolled out over the last couple of years. And just by the fact that this kind of looks like there's been like a final fine and that all of those issues are kind of been put behind them, it is hoped that this could be very good for these stocks moving forward, because they could have a lot less regulatory scrutiny in the future, and a lot of these kind of gray areas which were not defined in previous policies and which people could kind of step over the line because they didn't know that they were there. They have kind of been more fine-tuned and have provided more clarity for them. We've also seen that China's CPI remained unchanged in June from a year earlier and marked the weakest reading since February 2021. So as I said, the reopening of China hasn't really gone to plan. The demand hasn't been high as expected. But I personally just think it's a little bit delayed because it was shut down for such a long time. It takes like a while to stimulate the demand again for products and services. Also takes a while to stimulate and to be able to, people to go back into jobs, to increase productivity of factories, increase exports, imports, the whole thing. So I think it's just been delayed. Could be a good year, end of the year to 2023, and if it's not, and if it's too early, I'm expecting 2024 to be a lot brighter for Chinese equities. So our top 3 performing stocks for last week. The top performing stock for last week was Coinbase, and that was up about 33.78%. Coinbase got a very large uptick in the share price last week, and that was mainly because of this SEC case versus Ripple, in which Ripple got a partial win against the SEC, and it determined that XRP was not sold as a security on exchanges to buyers, in which case Coinbase immediately actually relisted XRP, which they took off during the beginning of the lawsuit, and now have relisted that straight away. It also is said that because the SEC have a case against Coinbase in which they're saying they're selling illegal securities, it'll be very difficult for the SEC to be able to win that case and to be able to define that the cryptos that they're selling can be said that they are securities. Because if XRP is a security, who's to say the other securities, such as what they're saying, Solana, Cardano, and other such projects, how can they say that they are really securities if XRP is not deemed a security? It is also sold on exchanges. So that was very good for Coinbase. The second best performing stock last week was Magnite, and that was up about 14.29%. Very good week last week for technology stocks. That's a technology stock, but based in the advertising industry. And the third best performing stock last week was Everbridge, and that was up 13.68%. Want to give, I don't usually include cryptos in this weekly performance, and that is because they're a little bit different from stocks and they do fluctuate a little bit. But I wanted to give an honorable mention to Stellar Lumens, XLM, which was up about 33.17%. We don't have we don't have XRP in our portfolio. And the reason why is I took that out of our portfolio when the case started. And that is because I knew it would be highly volatile and it was quite likely to go down in price, especially in the short term and as we went into a bear market, because of the scrutiny and the media coverage that was coming around in terms of the 𝘃𝗶𝗃𝗀𝗃 case. So I took it out of our portfolio, and actually it's just as well as I did, because it did draw down significantly in the bear market. However, I did keep Stellar Lumens, and Stellar Lumens was up about 33.17% last week. And that is because XLM, which is Stellar Lumens, is a very similar project to XRP. It's actually a fork of XRP. So because of that, although it does have a slightly different setup in terms of a foundation and other things, it's seen as a very similar project. So if XRP was deemed a security, it was very likely that Stellar Lumens was going to be seen as a security, and vice versa. Now that is not being seen as defined as a security, it's very likely that XLM is not a security. So that was up 33.17% for last week. All right, as I move on to the Death by Charts edition, I wanted to show the chart to the left. The US Consumer Price Index year-on-year chart. We can see that it actually went up to, what was it, around 9% at its peak. And now we are seeing that significantly decline. And really what we have seen is that significantly decline since its peak in June 2022. As you can see, it went down to 8.5 in July 2022. August 2022, it went down to 8.3, yada, yada, yada. So you understand that it's just consistently been going down. Yeah, I don't think there's any cases where it hasn't gone down from month to month since its peak. So now we're at a pretty good level, and we're not actually really that far away from the Fed's target, as I mentioned earlier. So it's actually gone a lot smoother, and it means that we've got a much bigger chance of having a soft landing than a hard landing type of recession. So it could be very good for stock prices moving forward. And it could make a shift in monetary policy and interest rate policy. If you look at the chart to the right, and that is the year-on-year change in terms of the breakdown of the different sectors and what CPI is actually made up of. As you can see, we basically had a reduction from last year in the majority of different sectors, especially in energy and different areas. We've seen a decline in the year-on-year increases as the kind of year has progressed. However, it was a little bit different for shelter, and that is because shelter, which is obviously accommodation, has a much bigger lagging rate, because it takes a lot longer for those kind of higher interest rates to really get into the economy and start to dissuade people from taking new housing, taking new houses, building new houses. The rent rates start to go down as well, because there's less demand for places, etc. So it's taken a little bit of while, and we've seen the 𝗁/CPI moving down to 7.8% year on year, and that was from a peak of 8.2% 2 months ago. So kind of peaked 2 months ago, and we are expecting, because of that lagging in the CPI data in terms of shelter, we're expecting that to kind of come down significantly, but gradually over the coming months to a more sustainable level. And when that does, I think it could have a real effect on the overall CPI data and actually could bring us below that 2% target of the Federal Reserve. And just like they overstimulate, like during COVID, they pumped more and more money into the economy, they could over quantitative tightening by increasing interest rates too far and for too long, and could undershoot obviously their target. And there's nothing the Fed hates more than deflation. If we look at the US inflation data, this is actually the US True Inflation, which is a website which actually monitors real-time inflation, because some of those data that you get from which come out from the Fed are a little bit outdated, and they don't take into account a lot of real-time data that's out there and is available, and a lot of it's done by surveys and other things. And we can actually see that the US true inflation number is actually 2.11%. And actually, I forgot that the US government's kind of going more and more towards this 3% kind of inflation target now, when it's kind of been talking about 2% for a kind of a long time. So as I said, I think that they could start to overshoot this. Okay, as we move on now to the crypto news and views, and a very eventful week in terms of crypto. So Bitcoin kind of stayed pretty flat. It was up slightly. There's still a lot of optimism. We're still over $30,000 a Bitcoin. There's still a lot of optimism around the ETFs that were refiled in the US over the last kind of month or so. That is leading a lot of people to think that we could have an extremely bullish 2024 and 2025. So the Bitcoin halving is actually happening in April 2024, or around about that date. It depends on the block, the block height, the block numbers. So what I'm actually expecting is, if we look at these ETF, spot ETF applications, spot ETFs are really important. And the reason why spot ETFs are really important is because when a customer buys Bitcoin from one of these ETF companies, then what happens is they actually have to buy and custody that Bitcoin. When they're dealing with future Bitcoin futures, which were approved, a lot of those were approved in 2021, they don't actually physically have to buy the Bitcoin and custody it. So it's a big difference. And once those Bitcoins are actually bought and those approvals of the Bitcoin spot ETFs are approved, then we could see a big influx of money into Bitcoin, and we could see a real supply shortage. And that, combined with a Bitcoin halving, which will halve the rewards, which happen every 4 years, halve the rewards for miners, plus a massive increase in demand, we could see a big supply shortage. So the current dates for some of those filings are towards the end of 2023. However, there is the possibility, and we have seen this with other applications before in the past, where they could extend those out and they could apply for extensions. But the final possible dates for extensions for the Bitcoin ETFs is actually the end of the beginning of 2024, just before that halving date in terms of the Bitcoin halving, which happens every 4 years, like I mentioned. BlackRock is the biggest asset management company in the world. They have a Bitcoin ETF applications. And then we also have Fidelity, which has a Bitcoin ETF application, and that is the third biggest asset manager in the world. And then we have Invesco, which is the seventh biggest asset management company in the world, and they all have these Bitcoin ETF applications. So if we think about just a small percentage of those, if just a small percentage of those, they decide to buy small percentages of Bitcoin for the institutional clients, the pension clients, the whoever's investing money through these asset managers, just a tiny proportion, we could see a real skyrocketing in the Bitcoin price in 2024 and 2025, in which we historically see bull runs anyway because of the halving situation. So keep an eye out for that. I think it could be very explosive in 2024 and 2025. But obviously a lot of things can happen in the meantime. So we will hold steady on our crypto positions. Okay, so one of the big pieces of news that I wanted to point out for last week was the Ripple case. Okay, so Ripple have had a long-standing case with the SEC since the end of 2020, which the SEC said that Ripple was selling illegal securities not only to its institutional clients, such as banks, etc., which XRP is supposed to be a gateway for and a bridging currency for foreign exchange, etc., and their ODL clients, etc. And also they were saying that the Ripple, the XRP that was sold on exchanges is deemed a security, yada, yada. And they also said that the top executives, Chris Larsen and also Brad Garlinghouse, they also got sued for selling illegal securities, etc. So it was a big case. This really stopped the bull run in the tracks. Even though 2021 was quite explosive for a lot of altcoins, it wasn't particularly for XRP, and that is because they had this legal case that was hanging over them and regulatory scrutiny upon them. So they had a very kind of a lame 2021. What we have seen is that they have been fighting this case on regard to the whole industry. And why it's really important is because the way XRP is defined because it's kind of the first project that's kind of taken it all the way with the SEC. Before that, any company that the SEC has sued, the companies have tried to close the case very quickly because they didn't have the legal muscle, the finances to be able to fight them, and they often settled for a big fine, etc. And XRP Ripple was really fought for the crypto community as a whole and has actually fought this. And one of the reasons for this is because if XRP is deemed a security, say they would have taken a settlement and said XRP was a security, then it wouldn't be able to list on the majority of exchanges in the US. And there would be a whole host of different issues around XRP as a token. And in turn, this would mean that they would have legal precedents to say that a lot of the other crypto altcoins were also security. They're being sold on exchanges as securities without permission, etc. in the US, and this would be extremely bad overall for the industry. So the fact that they've got this decision that XRP is not deemed by Judge Torres as a security, this is very good for other altcoin projects as well. So we saw Ripple XRP went up significantly. I think it got to about 80 something cents. It was up about 70 or 80% on the day of the split decision. XLM was up significantly as well, but we also saw other projects which the SEC had deemed previously as securities, which their case has now weakened significantly, such as Solana, also Cardano. They went up significantly as well last week. So this is very big news, and I think it's underestimated how big this news this is in the whole crypto sphere. And I think people are just very focused on XRP, but they don't realize what this means in terms of other crypto altcoin projects. Okay, so secondly, the second piece of news I also wanted to highlight was the Bitcoin Lightning Network, and that has been made possible on the Binance exchange, and which has been implemented on Binance. There's a lot of people that have been criticizing Binance, especially Bitcoin maximalists, who have said, how comes Binance had not been implementing the Bitcoin Lightning Network, which obviously makes fees a lot cheaper, transactions a lot faster. And obviously the adoption of Lightning Network has increased pretty significantly actually since El Salvador actually made Bitcoin legal tender, and their payments are made on the Lightning Network as well. So I see that as a good piece of technology news, and really shows that the Lightning Network is starting to be a little bit implemented a little bit wider. Third subject that I wanted to bring up again was to do with Bitcoin spot ETF. So two pieces of news here really. One, a Bitcoin spot ETF was approved in Europe. I think it was back at the beginning of the year, but actually it's going to go live now within the next month or so. This will be very good. Obviously, it's not quite on the scale that it would be if a Bitcoin ETF got approved in the US, but it's still, significant demand and inflows of people buying Bitcoin in Europe as an ETF, which is they call an ETP. And this will be very important for the future to add to the demand pressure. We also seen that in Australia, the first company has also applied for a Bitcoin spot ETF. That could take a little bit of a while to be approved. But if we do see approvals in the US, we've seen approvals in Europe already, and approvals all around the world for these ETF products, then this really means that they've probably got a higher likelihood in Australia of having this approved as well. Okay, last chart. This video has gone on for a bit longer than usual. And this, what I really wanted to bring up was a Bitcoin chart. And it goes back to a little bit about what I talked about at the beginning of Crypto News and Views, where I talked about the demand for Bitcoin ETFs, and that's kind of going in unison with the Bitcoin halving cycle. So what you can see on this chart is the Bitcoin cycle bottom index, and that is before and after the halving. And this is not done by date, it's done by kind of block count. So that means that we can overlay all of the three previous Bitcoin cycles and then kind of have a look at what we think might happen in terms of price. So I'm not going to be giving any outlandish targets for Bitcoin, price targets. I think price targets are a little bit disingenuous because it provides a lot of hopium to people, and a lot of different news events could happen in the meantime, and things can change and things can be quite fluid. But I really wanted to kind of look at this a little bit more holistically and look at the different cycles. And I'm going to focus a little bit on the last cycle. All right. A lot of you weren't around for the last cycle, especially the last Bitcoin bear market. So I'm not talking about the one that we are either in or we've just passed. I'm talking about the bear cycle of 2018 and the very beginning of 2019. So we went down to about 3,000, I think it was 3,400 or 3,600. I can't remember the exact number. but it went a lot lower than people were expecting it to go, off the highs of the previous 20,000 in December 2017. So a massive drawdown which occurred there. There were a lot of people then saying Bitcoin is dead, a little bit like they were when Bitcoin hit its low in this current bear market of 15,300, 15,400. Yeah. So what we saw from the low of that bear market, 3,400 or 3,500, to the high of $67,542 in November 2021, which was the absolute peak of the Bitcoin price in the last cycle. That was about a 19.5x, so nearly a 20x from the low to the high. If we look at the previous bear markets before that, I'm not going to go into them in a lot of detail, but obviously when a new asset class is in its infancy, so it's very new, because it's coming off a very low base and it just takes smaller numbers of people to buy Bitcoin in order for price appreciation to set in, and also obviously the halvings are a lot more significant the more Bitcoin that there is left to be supplied into the overall Bitcoin, overall 21 million coins, and that gets halved every 4 years. So what we saw is a lot higher returns in the first cycle of 2013, the second cycle of 2017, but also they drew down during those bear markets in between that a lot more than the last bear market, for example. So we saw a lot higher returns from the lows to the highs in the previous cycle, much more than the last cycle. Yeah. So what this is called is diminishing returns theory, and that is the older that a asset gets, the less volatile its returns. So the less volatile its upside, so the less its upside. However, the less risk. As an asset gets more mature, it becomes less risk, so the downside is a lot less. Yeah, so that's very important. So what I'm actually looking at this now is in the last bear market, and I've just been talking to someone about this. In the last bear market, there was a lot of expectations that a Bitcoin spot ETF was going to be approved. Actually, it was a little bit of hopium if we actually look at it compared with the news that's actually going on now and the people that were involved in actually filing those Bitcoin ETFs. So it was kind of Gemini and a lot of kind of crypto related exchanges and companies who were actually filing those, you know, with little or no experience in actually implementing those and going through the process. Now we're looking at massive names such as BlackRock, Fidelity and other names, and they would really only apply if they thought there was a big chance in them getting those Bitcoin spot ETFs approved, right? Not only that, but if they do get approved, the assets under custody are much higher than a lot of those crypto native firms. Yeah, so even if it's a very small percentage of their AUC goes into Bitcoin as an asset class, it's going to cause a lot of price appreciation. Yeah, so that is really important. So if I look at this from the first point of view, diminishing returns, I think it's quite safe to say that if it is diminishing returns, and it was a 20x from the previous low of the last bear market to the high of 67,542, I think it would be pretty conservative to say that we might 10x instead of 20x in the next bull market, because the asset has matured, there's less risk, right? So that would take us up to the low. Actually, it says here the low was 15,758 on the 9th of November. Yeah. So if that was a 10x on that, would actually be 157,000, just over 157,000 as the high, or whenever that is in this upcoming bull market or the next cycle, or blow off top, or whatever you want to call it. I don't think that's out of the realm of impossibility. I think that that's actually fairly conservative. If we increase 20x in the last bull market, I think half of those returns in the next bull market is definitely feasible. However, if you do think, and I'm under this feeling as well at the moment as I kind of analyze things, we've got these Bitcoin ETFs. We've seen a real reduction in Bitcoin on exchanges, left on exchanges. Yeah, people have been buying those at the cycle lows. They're not selling. There's a lot of hardcore Bitcoin supporters that are not selling their Bitcoin. They haven't moved their Bitcoin. So there's less Bitcoin on exchanges. There could be a massive approval of those Bitcoin ETFs, which get, you know, a small percentage of their AUC, could really increase demand for Bitcoin. Yeah. And if we then combine that with the halving that's going to happen, and miners are going to get half of the block rewards, so there's going to be miners are going to be basically selling less Bitcoin, and we all know the higher the price is, the more they tend to hoard their Bitcoin, and they don't tend to sell until, you know, very high towards the end of the Bitcoin bull market. I think we could have a massive Bitcoin shortage, and I don't want to provide any predictions on what the price could be, but I still think 10x could be very conservative. I think it could be 15x, it could even be 20x, but I'm not going to give price predictions because it's a little bit disingenuous to do so. But those are my thoughts anyway, and that's my rationale behind why I'm so bullish on Bitcoin and why it is the highest weighting in our portfolio. And as we know, as the Bitcoin price continues to go up, then people pile into crypto. They start off with Bitcoin, move into Ethereum, they go into mid caps, they then go into the smaller caps, etc. And then the kind of risk curve and the risk appetite increases. So if Bitcoin goes up, it's quite likely that we will see, similar to previous cycles, altcoins maybe even outperforming Bitcoin in the next cycle. But that tends to happen towards the end of the bull market rather than the beginning of bull market, because people kind of pile into Bitcoin, especially when there's institutional players involved. So longer than expected video, but I thought it was important to kind of give my overall views. So thank you very much for listening to this video. If you haven't joined my Discord group already, please join my Discord group. Lovely community of people. We're regularly having discussions, especially if you're new to the community. It's a really great way to ask me any questions, but also ask the community who are, you know, similar, like-minded people with similar experience to you. So thank you very much and have a great week ahead.